Be Wealthy and Smart, episode 1341.
Step into a world of wealth and financial freedom without budgets, boredom, or bosses on Be Wealthy and Smart. And now, here's your host, Linda P. Jones.
Welcome to Be Wealthy and Smart. I'm Linda P. Jones, America's Wealth Mentor, empowering women and men worldwide to financial freedom. On today's show, we're going to talk about the surprising economic slowdown that has happened at the beginning of April. Now, just to recap where we've been, last year, the Fed talked about 6 interest rate cuts happening in 2024 as things looked like they were starting to slow down. But as we got into 2024, the Fed talked about 3 cuts, then 2 cuts, then 1 cut, then maybe no interest rate cuts happening in 2024. And so the market and interest rates have backed up following the Fed's narrative. But what do we find out now? We're finding out that at the beginning of April of 2024, it is the lowest increase in 4 months, and the drivers of inflation have changed. According to S&P Global Market Intelligence's chief business economist, the U.S. economic upturn lost momentum at the start of the second quarter, and further pace may be lost in the coming months. So unexpectedly, things are slowing in April, and what we're seeing now is indications that the U.S. private sector activity are revealing a sharp and unexpected slowdown in the pace of growth in April 2024, marking the softest expansion since December of 2023. This is due to the Purchasing Managers Index, or PMI, surveys released Tuesday by S&P Global, and here are the key takeaways. The U.S. Composite Purchasing Managers Index, PMI, decelerated from 52.1 to 50.9, marking a 4-month low. In spite of that, April had the 15th consecutive month of output increase. The PMI fell from 51.7 to 50.9, missing expectations of a rise to 52, marking a 5-month low. The U.S. manufacturing PMI fell from 51.9 to 49.9, falling short of the 52 forecasted, hitting a 4-month low for manufacturing. Output growth moderated in accordance with weakened demand as new orders decreased for the first time in 6 months. Companies reduced employment for the first time in nearly 4 years, while business confidence also declined to its lowest level since last November. Inflation rates generally eased at the beginning of the second quarter, with both input costs and output prices rising at a slower pace overall, and manufacturing input cost inflation reached a 1-year high. So this is due to tougher business conditions, which led companies to reduce their workforce at a rate not seen since the global financial crisis, excluding the early pandemic lockdown months. According to Chris Williamson, chief business economist at S&P Global Market Intelligence. Lower demand and a cooling labor market resulted in reduced price pressures, with April showing a welcome slowdown in the pace of price increases for both goods and services. So we had that happening at the beginning of April, and we had the housing market, residential home sales, accelerating in March at a faster than expected pace as mortgage rates declined over the month, according to the Commerce Department. Sales of single-family homes totaled 693,000 for the month, considerably higher than the downwardly revised 637,000 in February, and better than the 669,000 estimate from Dow Jones. With the lower February total, the 8.8% gain in March was much higher than the 1.1% that was forecast. After dipping in January, the median sales price jumped back up to $430,700, which is the highest price level of homes since August of 2023. And interest rates for 30-year mortgages edged lower in March to below 7%, but have since rebounded, according to Bankrate. And as of yesterday, the 30-year fixed mortgage rate was 7.898%. So the reason why this Purchasing Managers Index survey is so significant is because the numbers fell below 50. And when you have numbers below 50 on the survey, that signals contraction, Numbers above 50 signal growth, numbers below 50 mean contraction. So it means the economy is actually starting to contract, and quite quickly. Now we'll see how the Fed responds to this, but we have definite signs that the economy is starting to weaken and inflation is coming down. So we'll see what happens in May as this news filters its way through the Federal Reserve and the economy. It looks like the market has gotten much too tight and interest rates have gone up too much, expecting that maybe nothing would happen this year with rates. But if this weakness continues, it looks like rates may start to come down ahead of any action taken by the Fed, and in anticipation of the Fed possibly being able to reduce rates based on this weakened data. So we'll see what happens, and I'll keep reporting to you with updates. If you haven't yet subscribed to Be Wealthy and Smart, hit the subscribe button and you'll be notified as soon as new podcasts are available. And all of my podcasts are on my website at lindapjones.com/podcasts. And while you're there, sign up for my weekly newsletter for wealth tips for your financial freedom. That's all for today. Until next time, live the good life and be wealthy and smart.
Thank you for listening to Be Wealthy and Smart with Linda P. Jones. Share the wealth and tell your family and friends about the show. Check out our website, blog, and social media for more riches at www.bewealthyandsmart.com.